The biggest float on the Australian stock market this year has been postponed. German-based construction company Bilfinger Berger has blamed adverse market conditions for the decision to scrap the listing of its Australian operation, Valimus. The company hoped to raise around $1.4 billion from the float when it was announced last month. Andrew Robertson reports.
Valimus is the recently renamed parent of construction companies Abbey Group, Postoned and Connect, companies which have built many Australian landmarks. Valimus is also a subsidiary of Germany's second largest construction company, Bilfinger Berger, and it will stay that way for now.
They are obviously price sensitive. They're not trying to sell this at any price. They've decided that they're not prepared to move below that $2.20 mark they put on it here. And so if they're not desperate sellers, then they may have to wait a little while until confidence returns.
Helping Bilfinger Berger make up its mind was the recent share market performance of Leighton Holdings, the only comparable company in Australia. Leighton shares have fallen from around $40 in March to just under $29. Its price-earnings ratio has dropped from 19 to 13.5 in the same period.
It's an appropriate point of comparison, and it's, again, not surprising that the owners of Valimus decided to, if you like, defer the sale until a more appropriate time.
Valimus earned 64% of its revenue from the public sector last year, helped by the building program paid for by the government stimulus package, a point Greg Hoffman believes should have made potential investors nervous.
When people looked at the fine print of the prospectus, they realised that they were buying into a collection of business that's probably heading into a downturn over the next 2 to 3 years as some of this government stimulus unwinds.
For Greg Hoffman, the withdrawal of the Valimus float highlights the fact that with the stock market depressed, initial public offerings are well and truly out of favour.
We had the big float of Myer, which was a real flop. We had GLG Group, the Gerard Lighting Group, which has been another flop, and we had Kathmandu. So we've had 3 floats where anybody who's stepped up to the plate and taken on the risk is sitting on hefty losses in some of those cases.
But that doesn't mean selling companies or raising capital has stopped. Asian companies are cashed up and ready to spend on keenly priced Australian assets.
We've seen a Singaporean entity take out the Sucrogen sugar business of CSR, actually gazumping another competitive bid from China. And today we also saw CSR announce the sale of their insulation building products companies in Asia as well. So there's quite a bit of activity in hard assets.
A trend that's set to continue and which has prompted the merger of China's biggest accounting firm, Shine Wing, with Australian counterpart Hall Chadwick. Shine Wing helped Chinese company Yancoal in its $3.2 billion takeover of Australia's Felix Resources, but it's also hoping to capitalise on Australian companies trying to get a foothold in China.
The first sort of collaboration, type of cooperation will be in resources, which is happening now. But then in the longer term, we have a lot more to offer, like in environmental technologies and also in food and agriculture technologies, which we always can provide China with something that they really need.
David Chu believes Australian firms looking to expand into China increasingly will form strategic alliances rather than purchase Chinese companies.